Do these two things now to survive the next market crash that might be happening right before our eyes.
The economic data is about to crater as Trump throws the kitchen sink out with the baby and the bathwater. And the question, therefore, is what do you do in this moment with your portfolio? Do you just buy the dip and hope and pray? Or is there a smarter strategy? I want to give you 2 pointers that have worked over the decades, in my experience, and walk you through the following. So let's get cracking. Trump is expected to blame the old BLS commissioner and reduce job numbers by up to 2 million. Yeah, 2 million, which would be the biggest adjustment ever. I'll share my screen with you here. Goldman Sachs was expecting about 750,000, maybe even 950,000 jobs just vanished. These are paper tiger jobs. They never existed. They were just made up in a spreadsheet. And he's doing that because he's hoping he's therefore going to get bigly 0.5 or even 1% rate cuts from the Fed. And that.
So if you ever want to know, Fed watch tool CME, if you ever want to know what the probabilities are for a Fed rate cut, Google this, Fed watch tool CME. Now, I worked in consulting with credit union senior executives, C-suite executives for a dozen years, right? Before I did this, actually, while at the same time as trading, I was working with credit union executives, showing them how to take less risk and make more money. This is one of the tools I used very, very frequently because they need to know, because of their balance sheets, how much the Fed moves will impact them, right? So if the Fed is raising overnight rates, that's great for financial institutions, right? Because they're basically going to get paid more to do the exact same thing they were doing before. But if the Fed cuts rates, that's going to obviously cut their income. How much really makes a big difference, right? So before the end of 2025, there is only, so current rates between 4.25, 4.50, there is only a 2.4% chance that we stay at this rate. So basically, consider it a 97.5% chance that we get a rate cut. How much of a rate cut? We don't know, right? 19% chance that it's 25 basis points. There is a 46% chance that it's at least 50 basis points. And then there's a 31% chance that's a 75 basis points, right? So most likely we're going to see a rate cut of some kind. We just don't know to what degree. And if we go out for another year, let's do the end of 2026. Well, clearly no one's going to know what that's going to be. So this is going to be all across the board here. But the consensus is somewhere between a final rate between 275 and 325. That would be 20, 40, 65-ish percent, a 66%. Hey, a bell curve, right? 68% chance. Who would you thought? 68% chance is going to fall right in the middle of the first standard deviation of a bell curve right here. Now, I don't know. You don't know. Felix doesn't know either, but that's where we're looking at today. Basically a 97.5% chance that rates do get cut at some point.
That would therefore set him up to win the midterms coming up. Now, for those begging for rate cuts, you might want to look back at 2001, 2008. What happened in 2001 and 2008? Well, the Fed started cutting rates just before unemployment spiked. And the lower rate cuts were not a win for us. It was the signal that the real damage was about to hit. So if the economy was healthy and booming, there would be no need to cut rates, right? That's the theory. You kind of want high rates if the economy is booming. But before this pivot happens and before rates become bad news, possibly, there is still time for you to protect your portfolio. Like literally just don't give up all your gains like you did at the beginning of the year, right? Most people did. And
is this where he's about to switch to the pitch to the masterclass? Let's see.
And I'm going to do something for you to help you build a more sustainable portfolio, one that actually gets you retired earlier. I will spend 2 hours.
Yep, that's a switch to a masterclass. All right, let's move on.
Going to get your sliced pineapple in a can from, or even those delicious peach halves. Well, Del Monte is bust with debt between $1 and $10 billion. What's $9 billion between friends? So there is something going on in the real economy which isn't brilliant. Now, Kittens are stepping on my keyboard, as you can probably tell, which is never useful. So what's Wall Street doing? Wall Street's doing one very, very simple thing. Wall Street is buying quality. Now, what the heck is quality? Well, have a look at what they bought last quarter. These are the 9, I believe it is, top stocks that hedge funds and the big funds bought last quarter. And I've literally got 3 kittens staring at this. That's how interesting I think it is. And these are pretty much all stocks with actually very, very solid numbers. So how do you define quality like that? How do you check your own portfolio, whether it's quality? Well, look, to me, it's 2 things. And I want you to write this down because otherwise you walk away and you'll be like, what was the second thing again? Okay, so the first thing is you want a bigly even moat. What's a moat? Big water thing around your company, lots of alligators in it, and nobody can cross the pond, the moat, to compete. So it makes it difficult for other companies to compete. There is one he says, Germanicness coming through. There is one very big indicator for that, which is gross margin.
Which doesn't matter. Doesn't matter at all. In fact, we talked about this book not that long ago, and I had it on my shelf for a while. And I read this once ages ago, and we covered a video not that long ago talking about the summary from this. And yesterday, as I was reading through this, by the way, is on Audible. As Chris, as you know, Chris likes to be a itty bitty baby boy and have his books read to him. So I got the Audible, and I was reading through this yesterday. So there on page 10, like we're not even deep in the book at all. There are 6 things that he says you should always do. First, never buy a stock or sell a stock without checking the chart. Has nothing to do with fundamentals. Literally nothing to do with fundamentals. In fact, I would tell you that the gross margin means literally dog shit. Literally dog shit. Because you're not going to get paid on how much gross margin a company has. Just a fact. Just a fact. If you are investing in a company, you're not investing in gross margin. You're investing in what the price is today, with the hope and hope that price is going to go up. Okay. Second, yeah, I can't say that anymore, Senior Wahoo. It's been banned, so I can't say it anymore. Number 2, never buy a stock when good news comes out. Never buy a stock when good news comes out. We just had that happen to us a couple of days ago in VKTX and Viking Therapeutics or whatever it was, right? Good news came out, stock was down 40%. Could we have seen that coming? No, we really couldn't have. Unfortunately, I wasn't even aware that news was coming out. Otherwise, Chris never trades through earnings ever. And that would have been one of those catalysts where I would have got out ahead of time. Unfortunately, it didn't work out. Right. So number 2 is never buy a stock when good news comes out, especially if the chart shows a significant advance prior to the news release. So let's talk about that. Right. Let's talk about Palantir. I want to go look at Palantir because he's saying never buy a stock before news release, earning right here, especially after it's had a lot of big move up into it. Palantir had earnings gapped up, and then it's right back down to where it was, or even less than it was before earnings, right? So you never want to buy a stock right after the news comes out. Yeah, some people in the Discord knew exactly what was coming, of course. Next, number 3, never buy a stock because it appears cheap after getting monkey hammered. He actually says after getting smashed, which we're going to call monkey hammer. Never buy a stock because it appears cheap after getting monkey hammered. When it sells off further, you'll find out how cheaper can get. So let's look at AMD as a great example of that, right? Never buy a stock after it's been monkey hammered because you don't know how cheap it's going to get. And I'm telling you, when I was reviewing other people's videos in January, and they were like, oh, now you have to buy AMD. You have to buy AMD. I literally was questioning myself. I'm like, what did these guys know that I don't know? Because all I can see is this is a big, ugly downtrend that's so obviously clear. And that was when AMD was around $119. AMD continued to fall for months, hitting a low of 76. It still went down 37% from when these people said it was cheap. From where they said it was cheap, it went down another 37%. Well, if you loved it at 119, I bet you thought it was the greatest stock ever at 76. Now, if you did buy it at 119, you got back to profitability in June. So you decided to take 6 months out of the market to make no money. 6 months out of the market to make absolutely no money. Or You can wait for the trend template to reverse and watch it go up. All right, let's go on here. Okay, number 4, never buy a stock in a downtrend on the chart. Never buy a stock in the downtrend on the chart. Well, that makes it easy. Okay, number 5, never hold a stock that is in a downtrend, no matter how low the PE ratio goes. So he's saying never buy a stock in a downtrend first, and never hold a stock in the middle of a downtrend because the PE ratio looks so amazing, right? One of those fundamental valuation metrics. And that's why I wanted to pull this out. Fundamentals mean nothing. I'm telling you for sure. If you are an investor in any stock, it can be AMD, it can be Palantir, it can be Nvidia, it can be Microsoft, it can be HIMS, it can be Google, it could be Celsius, it could be PayPal, any stock. Remember, all stocks are bad. All stocks are bad, but every once in a while they act right. Your job is to understand when they are acting right and when they're not. And don't use fundamentals to justify the fact that they're not acting right and I'm losing money, but it's okay. The fundamentals are there. Terrible, terrible, terrible. And number 6, always be consistent. Dude, David, AMD has been a huge moneymaker this year, but I can guarantee you weren't making money on this downtrend. I can tell you for sure you were not making a single dollar. In fact, you're probably losing lots of dollars until the downtrend changed on May 7th. Until the price went over 50 and the 10 over 20 crossed, that's when David was printing money, right? Tell me the truth, David. You and I both know the truth. You weren't getting paid until the 10 over 20 price over 50 outlier trend template that we talk about all the time actually shifted over. Yeah, David says exactly. I bought it as it was crashing up. Yeah, don't buy stocks as they're crashing down. Buy stocks as they're crashing up. There we go. So number 6, always be consistent. You've heard me say this all the time. Consistency and discipline is needed to be successful in this market. If you find that you're sometimes buying, sometimes selling in practically identical situations, there's probably something terribly wrong with your discipline, right? If you're always buying at the top and selling at the bottom, you probably have an issue with your discipline. So, little side tangent there. I love the trading game. Absolutely love the trading game. I can't get enough of it, right? This may not be your thing. This may not be your peanut butter to your jelly, but it is mine. So I love being able to talk about this. I don't care at all about fundamentals, and I certainly don't want you to care about what gross margin is, because that can lead you into a trap. That can lead you into a trap of saying, the gross margins are great, the company has to be great, I have to make money on it. But you could be sitting 6 months before you get just to break even. I don't want that to happen to you. I want you to be to profitability as fast as possible.
You want your gross margin to be greater than 60%, generally speaking. That's a pretty good number. Higher, the better. Your Visa and MasterCards achieve almost 100%. Your car manufacturers are typically at 10%, which is why they're crummy businesses. Now, what's the second one? Well, there is one other indicator which is equally as important, or perhaps even more important, that almost nobody really understands and nobody really looks at. So let me tell you what that is, if I can still see the screen with these 3 little rugrats here. Can you see them? You can only see one, yeah? Yeah, there are 2 more snuggling up to the screen. The second one is ROIC. What does that stand for?
Return on invested capital. Again, another metric that does nothing. If you want to look at NVIDIA, TSM, ASML. If you want to look at MELI or SE, hey, we just got out of SE. If you want to look at Amazon or Microsoft, if you want to look at UNH, and if you want to look at CHYM, none of this will pay you. To David's point right here, he used to invest on fundamentals and followed the Everything Money channel. It was a huge waste of time. Stocks frequently don't follow company fundamentals. It's all momentum. It's all momentum. It doesn't matter what any of the ROIC is, what the gross margin is. If the price is not crashing up, you're not getting paid. Stock can do whatever it's going to do, and the fundamentals can be disconnected from the stock for ages. You got to be able to follow price. We're going to move on because I really don't want to hear him talk more about fundamentals.
Up there. And you see the live heat map for the day for any of your watch lists, or also simply for the index, like the S&P. And you can change it by market cap or make every sector the same size. And you can see here, NVIDIA, Microsoft, Google, Meta, Amazon, they're all down. So they're not immune to this, right? And that has me a little concerned with the Mag 7s. So I'd be a little careful with the Mag 7, because the Mag 7 have outperformed the market so incredibly well.
Actually, I'm glad you brought this up. I want to do a side-by-side of, you'll like this. You'll like this. Hang on. I want to do a side-by-side because the S&P 500 is a market cap weighted index. So let's go to the SPY. Market cap meaning, and let me show you what I mean by that. Let me give you a visual representation of this. The bigger they are on this heat map, the larger market cap they have. Market cap is number of stocks outstanding times your price. That's your market cap. Pretty easy calculation. Some of these are really tiny. Like, let's go to this one right here. Like Masco Corp has a pretty small market cap. I don't know what it is. It doesn't matter what it is. But this is not going to do very much in regards to what the overall market is doing compared to something like Nvidia or Apple. And same thing over in this sector over here, right? Whatever this one is. Arch Capital Group Ltd is not going to do anything, not going to do a hill of beans, as they would say in Texas, compared to Amazon or Tesla, right? The big names up here will move the market in a greater fashion than any of the small names in a market cap weighted index. But on the left-hand side, this is the SPY, the market cap weighted index. On the right-hand side, you can look at one called RSP. This is a equal weight index. So none of these stocks have any more weight than anything else in RSP. Now, interesting to note, let me try and scoot this over here. There we go. Interesting to note that RSP actually has not been hitting new all-time highs since November of 2024. If we look at a equal weighting, we got pretty close, but up here, there's a lot of trapped buyers in the same area. And I'm wondering, because this is market cap weighted on the left-hand side, equal weighted on the right-hand side, does this have any bearing to say, you know what, overall market participants are ready to get out with equal weighting? And maybe that's part of what's happening against the market right here. I don't know. Just a theory, just a theory. And pretty interesting to see how different these two can be, right? When you have the huge weight of these big companies versus an equal weight, what a difference it is.
Well, there is an ETF called MAGS, MAGS, which you can follow, and it's had a pretty nice run up. So a little bit of a pullback would not surprise me at this particular moment. So a little bit of a warning there for you MAGS 7 gobblers. Now, you can also just see where is the money flowing. And I did a podcast yesterday on Market Beat, which is another great channel. Check it out. I'll repost it as well later today. And we're talking about where does the money flow? What do institutions do? Well, they look at where the money flows. There is little charts like this which tell you each sector.
I don't know this chart. Let's look at it bigger.
Each industry rather, and where the money is going. And you can look at, well, where's the money actually going? Well, look, home improvements. Well, what we were talking about last week, I was talking about home builders and related stocks, right? So those are going up nicely. We were looking at yesterday, or actually on Sunday, casinos. Well, Wynn is one of the big winners of yesterday. And looking at a day like yesterday and looking at, well, which stocks didn't falter? Who's got strength on the tough days? That's a good thing to do as well. And you can go on. A lot of the banks we've been bullish on. Yeah, there's a lot of stuff on here that we actually been looking at, a lot of the REITs and so on. And you might be thinking, no, I don't believe you, Felix. Well, if you look at my list from Sunday, which I share with my mentees, for example, auto parts, right? Doesn't sound very sexy, but yesterday, where is it? Somewhere in here. Let's have a look. Auto. Can we search this? Auto. Maybe they.
I don't know this chart. If someone has a link to where we can find this chart, please share it with me, because I don't know. It's pretty interesting. It doesn't look too terribly dissimilar from this S&P 500 map, just laid out differently. But I would be interested in taking a look at it.
Call it car. Try to please, the foreigners. Okay, I can't bloody find it, but it was on here somewhere. As a sector, industrials.
I'm actually surprised. I'll be 100% honest with you. I'm a little surprised that he left this in, because as you guys know, we record everything live and we just trim very little as needed. And I've noticed a lot of Felix's videos are a lot more highly polished, a lot more edited. We like to do it with minimal editing on purpose, right? Keep it as raw and real as possible. This is pretty raw and real for him. I got to say, I like that.
Well, you can tell how well I plan these videos. Trying to impress you, but yeah, no,
Charlotte, I agree with you. I am, and this is my personal opinion, and everybody's allowed to have an opinion. I don't think Felix actually trades. I think he's a paid actor, not an actual trader. And I don't know, it just comes across that way to me as well.
we're looking at a lot of those sectors that are actually doing quite nicely, whether it's auto parts, biotech stocks. Actually surprised me yesterday. So there was one stock on my list from last week, which is ABBV.
AbbVie, Manny in the chat has been talking about AbbVie for a minute. Manny, everybody pay respects to Manny in the chat. Manny, because this dude has been telling us about AbbVie for a minute. Let's go look at AbbVie. Bro's been getting paid, by the way. Congratulations to you, Manny. I want you to understand that I am very, very proud of you, very impressed that you have been just like raking in the dollars on AbbVie. Way to go, dude.
And again, it's here on my list from last week. Where is it here? ABBV. And look at that yesterday. Didn't do a lot. It only went down 0.1%, and that is strength in the face of adversity. So look for the strength builders in your portfolio and on your watch list, right? And if you understand the sector rotation, and it isn't based on rules, it's based on money flows. If you understand where the money is flowing before the money flows there, well, guess what? You're probably better set up. And you also stop holding on to the things that top out. Stocks top out. Stocks do not go up in a straight line. And once you understand that, well, you just make better decisions. So you know what to do. There's a link up there, Felix Schwenzer.
I'm not 100% sure if he's mentioned what the two things are to survive the next stock market crash. I have not come across that yet. Do we get to that point?
$1 billion of US stocks, $183 billion of global stocks. That's pretty big. So the downside risk is significant. I'm not trying to scare you or freak you out. I'm always just saying risk management, keeping our money, not having big losses. That's where we make money. So if everything goes wonderful, everything is good. If we go down a little bit, not so good. If we go down a lot, right? They're going to sell bigly. It's not hard to learn how the market moves. Honestly, it just isn't. It is just a same thing again and again and again.
I agree. And so here's what we're going to do. I'm actually going to teach you two things now to survive the next stock market crash, because I don't think Felix is ever going to do that other than say, number one, take my masterclass. Number two, take the masterclass. So number one thing that I want you to do is start paying attention to the moving averages of the market. If you see a close under the 10 EMA, I don't know why TradingView's taking its moment to load in. There we go. If you see a close under the 10 EMA, that is a huge red flag. Consider this a red light in the market. When you see it close over the 10 EMA, consider that a green light, right? You can make a ton of money just following one moving average. I'm telling you, you buy it when it closes over, you sell it when it closes under, just right here from A to B. This one example, 5.4% on the market. Let's do it on Palantir, right? Just A to B. Just crossing over the 10 EMA, crossing under the 10 EMA, okay? Let's use right here, a cross over, or on this candle, a cross under, 10% right there. You can make a buttload of money just doing that. Number one thing that I'd want you to do to make sure you survive a crash is pay attention. If you see stocks closing under their 10 EMAs, that is a break of the short-term trend. Now, does that mean it's going to crash? It doesn't always, right? Like right here, it doesn't always, but it is literally mathematically the first thing that will go. I'm going to show you on the SPX, October 1987. Let's do 1987 dash, it peaked in August. The very first thing that has to happen before a giant crash is a break of the 10 EMA. Now, it actually broke multiple times ahead of that, right? It actually broke multiple times before that point. But the first thing that will happen is the break of the 10 EMA. So number one thing is watch the 10 exponential moving average, okay? And I can do any crash you want. You name it, I can prove it to you because it is math. Math, 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 baby. All math, all day. Second, I want you to start looking at market breadth. Now, one of the things I used to look at, you could look at the MMFI. If you don't have outlier, this is one I used to use. Oh, is that in TradingView? I didn't know that. Hold on. I didn't know it was in TradingView. All. There we go. Cool. I didn't know that was there. MMFI is an indicator that'll show you how many stocks are above their own 50-day moving average. Now, if you don't have outlier, this is a great way to look at market breadth. You want to see the 10/20 price over 50. And in this case, we don't see that. If you don't have outlier, this is a free option for you. And you can make your charts look exactly the same as mine, get a free TradingView account, then get the free deep thought indicator. You can make your trades look exactly like mine. Then second, if you do have outlier, you can see a lot more detail. In fact, this may be yesterday. Let me refresh. You can see a ton more detail. First, you want to go to the market breadth tab. You want to be seeing if the number of buy signals is growing or shrinking, and if it's crossing over its 10 EMA. Next, you want to be looking at the individual uptrends or downtrends. Are we growing in trends or are we shrinking in downtrends? Right? That's what we're looking for over here. When you combine this data, you're going to have a lot deeper insight as to what's actually going on in the market and not just what price is doing. So my two takeaways for you is, number one, start using the 10 EMA on the S&P 500 or on anything you want. But at least if you're doing it on the S&P 500, you will get the feel of the market. Okay. And then second, if you don't have outlier, use MMFI. If you do have outlier, use the market breadth tab. All of this you can do for free. Every single bit that I just showed you, minus using the breadth indicator inside of outlier. But everything else you can do for free. So take a look at the trend of the market and then take a look at the trend of breadth. If breadth is rising and the market's rising, that is momentum in your favor. If breadth is falling and the trend is falling, that is momentum not in your favor. And the third thing that you can do is sit in cash and don't F up. Vanna White style. Sit in cash and don't F up. Because in all reality, there are going to be lots of times in the market where you can do anything. But the best thing to do is not do a damn thing except sit in cash and don't F up your portfolio. So there you go. That's two things that you can use to avoid the next market crash. And if you're ready to save time, make money, and start winning with less risk, click one of these two videos. We'll talk soon.